sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, it's been smooth sailing for stocks on the back of solid economic data, but Morgan Stanley's Chris Toomey sees volatility ahead. And later, price cuts and increased supply have the obesity drug market booming, but questions remain on who's picking up the tab for the miracle medicine. We begin with our expert panel on three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Elizabeth O'Brien, and Al Root. So, Ben, the leaders stumbled this past week in the market, and yet the troops marched on, and it wasn't a bad week.
Yeah, no, this was an NVIDIA week, and it was, everybody was watching what the earnings would be like. The market kind of freaked out a little bit ahead of it, and then the earnings came out, and the S&P 500 finished the week kind of flat, just up 0.2%, even though the stock dropped 6%. And I think that's really what's going on. The market here is looking at other things. The tech stocks, they did not do well. The Magnificent Seven, it didn't do well. But you had energy, financials, materials, they finished higher. And you ended up with a week where the Dow was at a high, the NASDAQ was down, and the S&P was flattish.
The Fed's preferred inflation gauge came in, confirming the story that, no, it's not coming down as fast as we'd like, but fairly nice clip, and that looks good for the market. Yeah,
it's at 2.5%, so no, it's not 2 yet, but it's heading there. And I think with that number, what we can see is that, the Fed the trajectory is right. And so the Fed can start looking at other things, and we do have other things to look at.
There seems to be some debate as to whether the Fed would move 25 or 50 basis points a quarter or half a percentage point. I don't see why they would do a full half. That could spook the market, but I guess there's some people think they might.
There are people, and I think the reason is partially because you listen to the Fed speakers talk, and they're talking about the so-called neutral rate, basically where rates should be to sort of keep the economy functioning the way it is. Don't do any harm, don't juice it at all, and it should be about 4%. That means that rates are quite a bit higher, and so you could see doing half a point. But I think you're absolutely right that people would say, "Whoa, what's going on? Why are they doing this? What do they know that we don't?"
Right. Okay. Let's talk more about NVIDIA, Al. Ben said they had good earnings and a lousy performance.
Yep.
They literally doubled earnings. A company that huge, that's incredibly unusual, and yet investors sold.
Yeah, the numbers with NVIDIA are amazing, right? And the stock was down about 8%, but again, it's up 100% over the past, or 150% over the past 18 months or something like that. This was the fifth straight quarter where revenues were up more than 100%. First time they topped $30 billion. Over the last 12 months, just under $100 billion in sales, up almost 200%. The numbers continually get amazing. I do think, but it starts to generate these questions of how long can this go on? The one thing that I find fascinating, 4 companies account for about 40% of sales, roughly speaking. That's Microsoft, Meta, Amazon, and Alphabet. Or if you rearrange those, it's the MAM.
The MAM, right? Yep.
And 40%, and those 4 companies are going to spend more than $200 billion on capital and equipment, basically building this AI infrastructure out. That's up 5-fold since 2017. Again, the numbers are just amazing.
But it may not be sustainable. Could we see a situation where you had Cisco in 2000, and literally that stock has not gotten back to where it was on March 31st, 2000.
Well, that's the fear.
24 years.
Good news, bad news, right? So Wall Street forecasts more growth in capital spending by the big 4 in 2025. So not yet, right? Maybe we were in the 1998 and we're not in 2000. Cisco in 2000 traded for about 20 times sales. This is the bad news. NVIDIA right now is trading for about 20 times sales.
Okay.
So, these things can't go on forever, and we're not saying that this is the end, but you do have to, basically, I would say people should watch the capital spending levels at those big 4 to see what's going to happen in NVIDIA.
All right, real quick, a lesser name but a bigger fall, Supermicro got hammered this past week.
So Supermicro, that actually accounts for about 9% of NVIDIA sales. They make servers. There was a short report that came out, basically questioned their accounting. Then the day after, they delayed their annual report. So the stock was down almost 30%. It's down 65% from its high.
Wow. Elizabeth, I want a very different subject here. You wrote an article about a controversial proposal backed by Kamala Harris to tax ultra-wealthy people in a different way. Set us straight, because there's some misconceptions about this.
There are, indeed. Yes, Silicon Valley is up in arms about this proposal. They say the tech gurus say it'll stifle innovation. But as you said, there have been a lot of misperceptions. Now, they're not coming after anyone at this table and the unrealized gains in our 401ks, right? This proposal would target...
Speak for yourself, Elizabeth.
Oh, well, all right. I am making assumptions. All right, maybe you are a secret bazillionaire, but if not, this is going after people with wealth of 100 million or more. So it's not a new capital gains tax. What it is a sort of part of a complicated effort to ensure that the ultra wealthy pay a minimum income tax of around 25%. It faces long odds as well. In order to, even have a chance of becoming law, we would need Democrats in control of the House and both chambers of, the White House and both chambers of Congress, and even if it were to pass into law, it would likely face serious legal challenges.
Yeah, I've heard from people in the legal field looking at finance that it may very well not be constitutional.
Right.
And there are other ways to address this issue. I mean, the big problem here is that people pay themselves a salary by borrowing against this wealth, so it's never actually realized. They actually deduct the interest on that borrowing.
Right. So the ultra wealthy pay effectively a lower rate
or
than
zero.
Or zero. Right.
Okay. Well, we'll see what happens if there's any solution. Thanks very much, Elizabeth. Stocks celebrating some positive economic data this week, but my next guest says there are reasons to be cautious. Why Morgan Stanley's Chris Toomey is concerned about the markets and where he's telling his clients to invest now. Some good signs for the economy this week. The Federal Reserve's key inflation gauge coming in lower than expected, gaining 2.5% over the past year and holding steady from a month ago. Earlier in the week, a second read of GDP came in at 3%. That's higher than previously reported and much higher than the previous quarter. All of this supports the soft landing thesis and a rate cut in a few weeks. But is it too early to be celebrating? Let's bring in Morgan Stanley private wealth advisor Chris Toomey. Chris, thanks for coming by the studio.
Thanks for having me, Jack.
So you and I took vacation, not to the same place, but at about the same time as the market just really kind of tanked, and then it's recovered almost all of that since then. What's the good news right now that's making investors' tails wag?
I mean, I think the good news is the economic data is kind of, like you said, coming in that sweet spot of Goldilocks, right? We've seen GDP starting to slow down, but not slow down too much. We've seen inflation come down into levels that the Fed's really more comfortable with. And so I think, the market has been pricing aggressively rate cuts for the last 18 months.
Incorrectly,
correct. And now the data-dependent Fed with Jackson Hole is now signaling that we've now kind of turned the page and we're now in a place that they feel comfortable where they're actually going to start cutting rates.
And you made an interesting point about the labor numbers, not great as unemployment creeps up, but you said it's partly for good reasons.
Yeah, I mean, look, obviously, if unemployment's too tight, that's going to be pressure on inflation,
sure,
and it's going to be pressure on margins for companies. So I think the Fed obviously wants to be in a situation where they're not necessarily too restrictive, but not too loose. And in an environment where it's too loose and inflation continues to rise, they can't necessarily start bringing rates down.
Okay, not all rainbows and unicorns. What keeps you up at night?
I think, one of the things that I think we're starting to see is, as I mentioned before, we're starting to see things moderate, right? So in a way, bad news was good news in the sense that as the economy started to slow, as inflation started to slow and unemployment started to tick up, that gave us an opportunity to start cutting back on rates. The concern is that maybe the Fed has waited too long and some of this economic data is softening. Some of these earnings are starting to soften. And I think a real concern is, are we in a situation where we waited too long to cut? And this could be a situation where the economy is actually not doing as well as we had thought.
And for that reason, you're a little bit underweight stocks right now. What area of the stock market are you in? What do you favor right now?
Well, look, I think we've been underweight stocks for a little while. I mean, part of it is the fact that we feel like valuations are not really that attractive right now. The market has been really driven by the Mag 7, which is well understood. A good part of that is the fact the Mag 7 has been doing so great from an earnings standpoint, and they've been really driving that multiple expansion within the S&P 500. If you look at the 493, 2023 earnings were basically relatively flat. I think the good news that we're seeing is we're in a situation where expectations for the 493 aren't really that exciting. exciting versus the Mag 7, which are very exaggerated.
Sure.
And in a situation like that, we think looking at the market in general, broadly speaking, you're in a situation where you're probably going to see kind of a flat return for a little while. But underneath that, there's going to be some real opportunities as you continue to see earnings in the 493 continue to outperform. And in that environment, we think that that's a good place to be putting money.
So to get the 493, you kind of like that equal weighted index rather than the cap weighted that over.
Yeah, I think with the focus on quote unquote quality and defensive. So we've been overweight in healthcare and some of the other areas that are actually doing quite well right now, which also may be a concern with regards to the market going forward, as we've seen a real pivot from technology and some of these higher beta names into these more defensive names.
I know you are enjoying the bond market right now, higher yields, some private credit. But before you go, I want to ask about the IPO market. Given how well the stock market has been doing, you'd think lots of companies would be coming to market, but they're not. Why is that?
You know, look, I think it's not necessarily a situation where the private markets are completely broken, right? We're in a situation where, you know, for the last 10 or 15 years, you could underwrite at essentially zero, right? And so now we're in a situation where some of those business models are going to change now that interest rates are at a more normalized level. I think the bigger issue within the private market is the fact that the valuations during kind of the boom after COVID are still at very high levels. And so a lot of these private companies are trying to kind of wait things out, hoping that the Fed kind of comes in, reduces rates, and they can go in and get some cheaper financing in order to keep the operations going. And so I think that's another concern with regards to the market, is the fact that we're not necessarily seeing the IPOs that you would expect in a market like this.
And I know you expect volatility between now and the election, so we'll have you back to find out what's happening then.
Great.
Thanks, Chris.
Thanks for having me.
Appreciate it. Positive news for obesity drugs is pushing the industry to new heights, but who's picking up the tab for the revolutionary new medicine? We'll discuss next. Great news out of the obesity medicine market, now exciting investors as shortages ease and manufacturers announce price cuts. But celebrations may be premature as questions remain over who's actually footing the bill for these drugs. Ben, so lots of good news. We keep on getting more and more good news about the things that these medicines can cure. Give us the good stuff first.
Well, I mean, I think the best thing about these are the stocks. They just keep going up and up and up. Eli Lilly is up, I think, 700 and something % over the past 5 years. And it's partially because these obesity drugs are really all that matter. I mean, they start off as diabetes drugs, and now they turn out to help lose weight, but they do all kinds of other things, too. Lilly came out with some data to show that it might actually prevent type 2 diabetes, but it's also been shown to help with sleep apnea, heart failure, addiction, Alzheimer's. I'm waiting for it to come out with a way to bring world peace.
Oh, that would be nice.
That'd be great. I mean, they're fantastic.
Sure. That said, there's enormous revenue potential here, but in order to get revenue, somebody has to spend money, and it's not clear who's actually going to pay the very high price of these drugs.
Yeah, I mean, they're already trying to come up with new ways to do this. Eli Lilly came out with a new way, a discounted version of Zepbound, which is a little complicated to use, but it does bring the price down. But it's still, they're very expensive, and especially for weight loss. You see that a lot of the insurers don't want to pay for it. And so we had a reporter, Josh Nathan Kazis, talk to a hospital administrator who said that there's about 40% of patients who really should be able to get it that just don't get approved. And even North Carolina's public employee health plan, it stopped covering the drug for weight loss.
Wow.
So it would have doubled the premiums for everyone. It's just too expensive at this point.
Yeah, and even beyond the sort of the coverage issues, there are concerns that these semaglutide drugs could, renewed concerns about serious side effects such as suicidal thoughts.
That's a fairly serious side effect.
Very serious side effect, yeah.
Elizabeth, speaking of paying, Medicare, I believe, is the largest single purchaser of drugs in this country, and it's not clear what Medicare's policy will be.
Right. Medicare by law cannot cover drugs solely for weight loss. Now, it can cover weight loss drugs that are approved for other uses, such as preventing strokes and other cardiac events. So how this is all going to shake out from a cost perspective remains to be seen, both from an individual perspective and on a program-wide level. It's going to depend on how many people are approved to take the drug. By one estimate, about a quarter of the obese and overweight Medicare population might be approved to take it. So not everybody. It's also going to depend on how the Part D drug plans decide to cover it. Are they going to cover it? And if so, at what coverage tier? If it's placed into a specialty tier, by some estimates, it could cost several $100s a month for the beneficiaries.
All right. Al, recently on the show, we talked about a company called Hims and Hers that had taken the opportunity to jump into this market, create a copycat drug. Is that road coming to an end?
I'm smiling. I thought you were going to ask me if I was familiar. I'm not going to comment. But Hims, so this is one of those situations where Wall Street loves growth. They got into the GLP-1 business in May of this year. And because it's in short supply, they find loopholes and they're able to use these compounding pharmacies and sell these basically patented drugs. So people are worried that, maybe there's a risk there. Right now, we're talking about tens of millions of dollars for a company that's supposed to do about $1.4 billion. The CEO says it's not going to go away, even if they come off of the shortage list, and even if Lilly and the likes start offering lower prices. There'll still be ways for them to manage that and to use this as a growth engine. So I don't think it's a huge risk for Hims, but it's one of these things that investors should be watching.
Meanwhile, even beyond that company, there are other players in this space other than Lilly and Novo. It's a pretty big market. Who should we watch to get in?
Yeah, Jeffries had a nice note about other players in the weight loss market. Amgen is a giant. That's one with a GLP-1 inhibitor in phase 2 trials. Phase 2 come before phase 3. And then 2 others with phase 2 trials that are smaller companies. Structure Therapeutics and Viking Therapeutics are 2 to look for.
All right. Ben, beyond this particular obesity problem, the healthcare industry is really coming back to life in the stock market after quite a few bad years. What's driving that?
Well, I think what's interesting is that there really hadn't been anything except obesity working. But now what we're seeing is that the stocks are actually rallying. They've had a very good 3 months, and it's largely because of interest rates. A lot of biotech stocks aren't making money yet. They need to have access to cash, and lower interest rates mean that cash is cheaper. And that's really a good thing. And so you're seeing, but there are also other treatments that are worth watching, and other stocks are worth watching, even if they don't have the obesity drugs. One that I've liked before is Gilead Sciences. Gilead has an HIV treatment that it's very big in that business, has a new treatment coming that you don't take as often, which could be a big hit. And then there's one called Vertex, which has a non-opioid painkiller, which is trying to fill that gap left by the addiction that's been caused by the opioids. So there's a lot of stuff out there, and because the Fed is cutting rates, they're actually starting to look interesting, and they're starting to move.
That would be huge if we could avoid the opiate problem. Thanks, Ben. Elizabeth and Al have a pair of investment ideas, and Ben is looking at what's in store for stocks this fall. Stay right there. Ben, Labor Day weekend, there's a crispness in the air. Colorado won a football game. That means it is time for the Barron's Fall Outlook. What does the Outlook say?
Well, the Outlook says don't get excited. I mean, we can get excited about the football games. I'm actually excited for pro football starting. The Broncos have a new quarterback. It could be exciting. But for the stock market, remember, the stock market has gone up 18% this year. It is not cheap. It's around 21 times earnings. And Paul LaMonica, who wrote our Outlook, he just warns that, you know what? It might not be super exciting for the rest of the year. Big tech, it seems like there's a little bit of uncertainty there. The big gains have been had. And we have all these other stocks that look really good, but they may not be enough to keep the market going up. And of course, we have the election coming, which could be its own source of volatility out there. And so he says, hey, just be happy if the market can make it through the end of the year. It's pretty much flat.
What does he like within the market?
Well, let's start with some stocks. He does like some tech. He likes Broadcom. He thinks that is the chip stock to own. He also likes GE Aerospace and TransDigm. I'm putting them together. GE Aerospace builds engines for jets. TransDigm does parts for the aftermarket. And GE Aerospace was a pick from Al for Barron's, and that stock has done extremely well. He expects it to keep going. He also likes NASDAQ, the stock exchange, not the market itself, and he likes pet meds company Zoetis. Okay. He also there are a couple sectors that he likes. He likes utilities, and he likes real estate, and he also likes small caps. He thinks those are going to be great plays until the end of the year.
Contrarian bet from Paul. All righty, thanks. Al, let's go to actionable ideas. You got another one.
Yeah, I have to send Paul $20 for his backing industrial stocks. But I have another industrial, and it was written by our friend Jacob Sonnenschein, Vertiv. It's like the picks and shovels play for this AI boom. Now, we talked about NVIDIA. Things are still good. Vertiv, it makes data centers and services data centers. It trades for about 25 times earnings. That's pretty pricey, but it's supposed to grow earnings at about 25%. That's about 3 times faster than the market. So it's another way to play the AI boom. It's a good company. Read the story from Jacob.
So you don't necessarily have to bet on NVIDIA or the MAM trade, who,
Yeah.
if anybody wants to build these things, these guys might build it.
Yep.
Alrighty. And Elizabeth, your pick comes from the Barron's cover story on the high cost of raising children, having just paid a tuition bill. I know what that's all about. So do you.
Yeah,
Tell us about this stock.
Yeah, so the stock is Bright Horizons. They provide backup childcare to employees of companies. Their clients are about half of the Fortune 500 companies are their clients. Now, they're not cheap. They're trading at about 35 times next year's expected earnings, but Wall Street sees more upside next year as they continue to recover from the COVID slowdown. And I can say when my kids were younger, I used Bright Horizons a lot. It's a great company. It's a great corporate benefit.
Yeah, I use them as well. They're pretty good. Thanks, Elizabeth. Great ideas from both of you. To read more, check out this week's edition at barrons.com. And that's all for us. We'll see you next week on